Thanks a lot, guys, for giving such an awesome response to the free training in the last couple of videos. This is the third video in the training series, and today I'm going to do it again. I'm going to flat out give you another trading methodology coming right from my own private vault. And this one is Powerhouse, guys. This is the exact customized system I have personally used to make tons of profits over the last 16 years. But before I do that, I really want to say it again. I appreciate it, guys. I'm absolutely overwhelmed by the positive feedback I've been getting about the first two videos. Your feedback is truly what motivates me the most. And I've definitely got more raving responses than I expected. I mean, 1,215 emails and comments in just a couple of days? I really can't ask for more. Normally, our totally unprofessional website gets no more than 100 views a day. But over the past few days, 24,950 traders have stumped upon our website and viewed the free training video series. Our email list has exploded off the chart and jumped from just a little over 2,000 people to over 20,000, almost entirely due to word of mouth. I guess Ralph Waldo Emerson's right after all when he said build a better mousetrap and the world will beat a path to your door. And you know Cousin Dean always over-delivers, don't you? This one is no exception, pure and actionable content, no pitch or anything like that. So let's start this video with research from my friends at Uppsala University on the money management and position sizing effects on trader performance. This is important, so drop everything that you're doing right now and just pay attention. The main purpose of the study was to find evidence for the importance of position sizing. The results showed that in order to survive trading in a simulated financial market using a positive expectancy trading system, you should take positions in sizes of approximately 3.7% to 6.6% as the surviving traders, rather than 22.9% to 23.7% as the bankrupt traders. Further, to be able to increase one's account over the long run and actually make money by trading the simulated market, you should not risk much more than 6% as the winning traders did on the average. Accordingly, deciding how big your position should be was of crucial importance. Whether the participating traders would lose all their money, get into debt, and not be able to trade anymore, or if they would gain profits of up to $871,000 as the best performing trader did, an increase of 8,500%, was primarily determined by their position sizing strategies, since position size was the only variable that they could affect. Because of the utmost importance of position sizing strategies, as proved by numerous studies, no wonder our scientifically proven best performing money management model, the P+3X model, has been hailed as the real key to long-term profitability by many institutions. Now, let me quickly share with you a personal story. I only shared this P+3X model with less than 20 institutional dealers and market makers 5 years ago, and recently I asked them if they thought it was worth their investment. Although these big dogs paid $25,000 each to learn it, all of them replied with an enthusiastic yes. Every single person has told me I wanted way too little for it, probably because it contains the most explosive secrets published in years. But to be candid, I think you're in a better position than these institutions and mutual funds. Why? Because they only got to learn the theory of this powerful money management model. The rest is up to them to design their own software, systems, and indicators to take full advantage of its power. But you don't need to do any part of it. Over the last 5 years, with the advent of new technologies, my teams have been able to develop our proprietary Sublime Champion system that intelligently incorporates the P+3X position sizing model in their backbone. And that's why I said to you, you're in a much better position because 99% of the work is already done for you. Our powerful P+3X model is already coded in each and every custom indicator we use in our Sublime Champion trading systems. All that's left for you to do is plug in our custom indicators, follow our systems, and profit. And I would venture to say that these Sublime Champion systems are much more powerful than even the best systems and processes currently used in the trading rooms of many institutions, simply because I am the one who came up with the original concept and taught it to them. Anyway, if you want to learn more about the P+3X model, how it's aptly built in the whole Sublime Champion indicator suite, and how powerful they perform in real live battlefield trading, even in the most cruel market scenarios one can experience, I suggest you should register for our coming free training webinar at www.sublimeforexchampions.com/webinar. This will be the most fascinating and eye-opening event you ever attend. That much I promise. On the webinar, we will also demonstrate how we skillfully integrate 4 subsets of these proprietary Sublime indicators and then take it to the next level, hone it to perfection, and fully develop them into 4 unique trading systems. And why experts agree that these Sublime Champion trading systems are the best performing plug-in and profit wealth building solutions. The simple answer would be because we've got the substance, the technology, and the massive proof to back it up. You'll learn more on our free training webinar, so don't hesitate. Reserve your seat right now by going to www.sublimeforexchampions.com/webinar. This is the only way we can send your attendance and login instructions in time. Moving on, let's get straight to today's core training, introducing the Breakout Fader methodology. As you already know, many traders like to trade breakouts, but with this strategy, we're doing the opposite. The simple fact is that most breakouts run out of steam before they ever really get moving. Knowing this fact, we can trade the fade of the false breakouts or fakeouts and profit from them. Taking advantage of these types of opportunities is known as the breakout fade or fading breakouts. This system is best traded on the hourly charts, but it can also be traded on the 30-minute, 4-hour, or even daily charts. What is fading breakout? Looking at the chart below, you can see an example of what a fading breakout looks like. The currency pair has a breakout after a period of consolidation. It retraced for a time, and then it looked like it was breaking out again. However, it stopped and reversed, and that's when we trade the fade. This type of trading is about finding the patterns on the chart and realizing that most breakouts fail. This simple realization can allow you to profit by trading against rather than with the breakout. Even though fading breakouts is a counterintuitive strategy, it can be an easy way to make gains from short-term trades. Finding fading breakout opportunities. To trade the fading breakouts, the first thing you need to do is learn how to discover the right opportunities to do so. We'll cover 3 different indications for trading the fade, and then we'll talk about the right market conditions to trade in. Basically, there are 3 ways to look for fading breakouts. We look at the charts to find trend lines, head and shoulders patterns, and or double tops or bottoms. Once we've found these, we look for the right opportunities to trade the fake out. Let's cover how to chart and see opportunities with all 3 chart patterns. Trend lines. One of the easiest ways to trade the fakeouts is with trend lines. This is very much like the idea I mentioned in the last section on riding the trends. The price will have a tendency to bounce off the trend line that you drew. By entering when the price is bouncing, you have an excellent point of entry. The only difference in this case is that we aren't specifically trading with the trend. We are, but we don't care what stage the trend is currently in. Rather, we're waiting for opportunities that look like a breakout, reversal, and profiting from them when they don't follow through. Let's look at a couple of examples to add clarity to this. One thing to note before we do is that with this type of trade, you are looking for gently sloping trend lines, 45 degrees or less. Trading anything faster than that, and you'll likely end up trading against a real breakout. Looking at the chart above, a gently sloping trend line has been drawn, and as expected, the currency has neared the trend line and bounced a few times. At the point where the currency price breaks through the line, however, many traders would be looking to trade the breakout. As it broke through, you would place a buy order a few pips below the trend line with a stop 20 pips above. By doing so, you'd be able to catch the profits on the fade. Let's look at another example of breakout fade in an uptrend. Looking at the chart in the next page, the US dollar Japanese yen is on its way up. The trend itself is actually a long trend that is beginning to run out of steam. However, we can still trade the fading breakout. The trend is gently sloping upwards, and as expected, the currency price has neared the trend line and bounced a few times. At one point, though, it looks like a breakout may occur. We place our entry order a few pips above the trend line, a stop about 20 to 30 pips back, and again, we have a successful trade. One important thing to note here is that when you're making these kinds of trades, you should be using both stops and take profits. If your stop is 25 pips, a 50 pip take profit is what you should be looking for, 2 times the stop. With a trade above, you would have made 50 pips in 3 hours. The downtrend example would have required a 30 pip stop and a 60 pip take